when a private MBS is issued by Fannie Mae or Freddie Mac, that implicit guarantee that the Fed will keep an eye on those two agencies and make sure that they do not fail financially, that helps maintain or allow for a lower yield to be offered on those securities when they're sold in the secondary market to investors all over the world. And that implicit guarantee helps keep that yield lower. And that, of course, the result is the mortgage rate on those loans that are collateralized in those pools is going to be a little bit better than if there was no guarantee at all. Explicit is more direct. That's where an explicit guarantee is the agency outright is owned by the government. So you have the full faith and credit of the federal government behind that agency. And in that case, the securities, the mortgage-backed securities that they sell in the financial markets. And Ginnie Mae is a good example of that. Fully owned by the federal government. Ginnie Mae pools, FHA, VA, USDA loans. And then they, with those pools of loans, they create Ginnie Mae securities that they sell in the financial markets throughout the world, and of course can sell to entities, including the Federal Reserve. The Federal Reserve can buy those because they have the full explicit guarantee of the federal government. If that explicit guarantee wasn't there, the Fed would not be able to buy those kind of securities, which of course, if that weren't happening, then the rates on the underlying loans for those securities would have to be higher to account for the additional risk of not having that explicit guarantee.
And again, forgive me, but this seems like a good point to ask a question. So if it's explicit, let's use Ginnie Mae, does that mean it's not tied to the 10-year?
That's correct. Remember that the 10-year bond that I harp on all the time, it's a benchmark or barometer. There's not a one-to-one relationship between the 10-year Treasury bond and, let's say, a Ginnie Mae mortgage-backed bond. Those are two different instruments. They're both bonds, but they're not identical in terms of what kind of yield they offer. A good example of where you can see this difference between explicit guarantee for mortgages that are pooled into securities and implicit guarantee on mortgages that are pooled for securities as well, where you can see the difference in rate on those underlying mortgages is comparing FHA to conventional. Again, conventional simply means not insured by the government, not guaranteed by the government, but these loans are typically sold to Fannie Mae and Freddie Mac. In almost any scenario, an FHA loan, VA loan, you're going to see a rate that's probably going to be somewhere around 0.5% or more better than a conventional a conventional Fannie Mae or Freddie Mac loan. The reason for that rate spread is in very large part the implicit guarantee, that's Fannie Mae, Freddie Mac, and the explicit guarantee, that's FHA, VA, and USDA.